The year 2023 is yours. You're finally getting serious about investing, and you're going to put in the effort to secure your financial independence. As you might assume, investing is not always as straightforward as 1, 2, 3. So, in this video, let's discuss 5 common investing mistakes that most people don't even realize they're making. Mistakes that will be particularly relevant for the 2023 investing environment that we're going to face, namely persistently high inflation, rising interest rates, a declining stock market, and widespread pessimism. Let's get started. Welcome back at Financial Fortune, your daily advisor that gives you news and tips for financial success. Just keep on watching. First, this is a fairly typical mistake that people fall into, and it will be especially detrimental in 2023. Never ever listen to predictions regarding the direction of the stock market, because as much as I'd like it to be true, absolutely no one on earth can anticipate the short-term direction of the stock market. It's impossible, but what's incredibly aggravating is the deluge of media coverage attempting to convince you that someone who appeared on a show or program yesterday actually knows where the stock market is headed. This is pure nonsense, and the only reason the mainstream media perpetuates it is because they know that fools enjoy clicking on such information. They put it out because it generates revenue, and what's weird is that it's a lot more formulaic than you might expect. Studies have shown that when the stock market is increasing, media coverage tends to be excessively optimistic, but when the stock market is falling, media coverage tends to be too gloomy. It is actually absurd, yet true. They are merely attempting to get you to click, so please do not fall for it. Remember Buffett's bet in 2008, where he bet these hedge fund tycoons usually found on CNBC that they couldn't even beat the market over a 10-year period. Protégé partners really took on the wager and lost miserably. In the United States, 89 of these active fund managers shown on CNBC do not even outperform the S&P 500. So how accurate are their stock market forecasts? The second error is selling a successful firm because it is declining. Sometimes your emotions get the best of you, and you feel the urge to sell due to a sinking market. Or if I take a 30% loss now, maybe I'll avoid a 50 or 60% loss. Nevertheless, this line of thought of selling a company because it's declining is absolutely wrong. Recall that when stock prices fall across the board, if you're interested in high-quality companies, this is a discount. It is identical to strolling into a department store and seeing 50% off signs. When this occurs, you don't feel anxious, do you? The same should occur when the stock market crashes. Nevertheless, the stock market is the only place where shoppers flee the store during a sale, as the saying goes. It's absurd if you know you own high-quality firms with solid foundations and a minimal danger of bankruptcy. Don't sell merely because the market is fluctuating, and don't lock in a loss. Doing so is completely worthless. Listen to Warren Buffett discuss this topic.
If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and you should pay attention to those bobs up and down.
As an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And that's the way I look at my own stock. That's the way Charlie looks at his stock.
The third error is burying one's head in the sand. As an active stock market investor, you must have your finger on the market's pulse. You do not need to worry or believe everything you see on CNBC. This goes back to point number 1. But you should avoid making investments and then forgetting about them. This is typically the case when you are sitting on a substantial unrealized gain. Several investors made a fortune on paper in 2020 and 2021, but if they became arrogant, 2022 would have humbled them somewhat. In the stock market, it is essential to be current. Yet, if you've invested in specific businesses, you must also guarantee that the fundamentals remain solid and the story doesn't change. This will be especially relevant in 2023 due to the high rate of macroeconomic change, which takes us directly to the fourth error that will be especially relevant in 2023, placing bets based on macroeconomic developments. For those unfamiliar, macroeconomics is the study of economic output, interest rates, inflation, and foreign exchange rates, and let's be honest, this is pretty much all the news is focusing on right now because so much is happening in this area. Understanding macroeconomics is essential, but should you focus on it and make decisions based on it? Certainly not, because this information is completely unknowable, similar to stock market forecasting. Nobody is able to generate reliable macroeconomic forecasts, not even central banks that control a significant portion of these levers. So, attempting to anticipate future interest rates or inflation is a waste of time, and attempting to make investments based on these factors is an even greater error. The top investors in the world generally disregard this information and instead focus on the fundamental strength of the firms they wish to invest in. They are well versed in the macroeconomic environment, but do not allow it to influence their investing decisions. This is how they get phenomenal returns. They acquire businesses that are so robust that they succeed regardless of macroeconomic conditions. This clip has been played 1,000,000 times, but please listen to Peter Lynch discuss this.
People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. And no one can predict the economy. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates going to be 12%. That's useful stuff. You never know it, though. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
As Peter Lynch advises, don't waste your time on the macro, and from there, the last major error that is particularly pertinent to 2023 is trying to enter the market at its bottom. The stock market has been generally trending down over the past 12 months, and it may continue to do so over the next 12 months. However, it is unrealistic to believe that you will be able to drop your life savings into the market at its lowest point. If you believe this, you will be trapped in a never-ending cycle of either disappointment because you missed the bottom or frustration because you can't find it. Even in 2017 or 2018, I believe the stock market was way too hot. Yet, if I had stayed out of the market and waited for a stock market crash before buying, I would have missed out on such a phenomenal run and so many gains. In retrospect, it would have been wiser for a long-term investor to begin investing immediately and take advantage of each opportunity as it arose, as opposed to waiting years for a major stock market crash and then attempting to timing the market bottom. Today, we are doing well and are attempting to find the bottom. It's just not possible, therefore don't do it. There are 5 investing errors that are quite important in the current situation. Please give this video a thumbs up if you enjoyed it and found it useful. Don't forget to comment on the tips you find to be the most useful. Having stated that, we will see you in the future video.